Hey folks, Bojas from Independent Solutions here. The early 1990s marked a period of significant economic transformation in China. The country was transitioning from a centrally planned economy to a more market-oriented system. At the heart of this transition was the banking sector. Chinese banks in the early 1990s were largely state-owned and operated under the direction of the government. They primarily served as financial intermediaries, channeling funds from savers to state-owned enterprises, or SOEs. These SOEs were the backbone of the Chinese economy at the time. However, many were inefficient and burdened by overemployment. Banks were often directed to lend to SOEs regardless of their creditworthiness. This practice led to a build-up of risky loans on bank balance sheets. Despite these challenges, the Chinese banking system was seen as stable in the early 1990s. The government maintained strict control over interest rates and capital flows. The economy was experiencing rapid growth. This growth masked the underlying weaknesses in the banking sector. However, the seeds of a future crisis were being sown. As China's economic reforms progressed, the problems within the banking system became increasingly apparent. The reliance on policy lending to SOEs resulted in a surge in non-performing loans, or NPLs. These loans were unlikely to be repaid, putting significant pressure on bank balance sheets. The situation worsened with the onset of the 1997 Asian financial crisis. The crisis exposed the vulnerabilities of many Asian economies, including China's. Foreign investors began to withdraw capital from the region. This put further strain on Chinese banks. The rise in NPLs threatened the stability of the entire financial system. A full-blown banking crisis could have derailed China's economic progress. The government recognized the severity of the situation. It began to implement a series of reforms aimed at restructuring the banking sector and addressing the NPL problem. The Chinese government understood that addressing that banking crisis was crucial for maintaining economic stability. Their response was multifaceted and aggressive. One of the first steps was to establish 4 asset management companies, or AMCs. These AMCs were tasked with taking over and managing the bad loans from the Big 4 state-owned banks. The creation of AMCs was a significant step towards isolating the bad loans and allowing the banks to start fresh. The government also implemented stricter lending standards and regulations to prevent a repeat of the NPL crisis. These measures were designed to instill greater financial discipline within the banking system. Taking on the burden of bad loans had left the 4 largest state-owned banks severely undercapitalized. This meant they lacked the necessary financial cushion to absorb potential losses and continue lending. To address this, the government injected substantial capital into these banks. This recapitalization was intended to strengthen their balance sheets and restore confidence in the banking system. The government recognized that a healthy banking sector was essential for supporting economic growth. However, the recapitalization efforts were not without their limitations. The focus on the Big 4 meant that smaller banks, often struggling with similar issues, did not receive the same level of support. This raised concerns about the long-term health of the entire banking sector. Despite these limitations, the recapitalization was a necessary step in stabilizing the Chinese financial system.